All right, so welcome everyone to our latest webinar. It's only been a couple of weeks since our last webinar. Really, we probably weren't planning on doing this so quickly, but as most of you probably heard, that we have brand new legislation out from DC that was passed by the House yesterday and the Senate very late last night, and making some very material changes to the PPP, the Paycheck Protection Program, both for existing borrowers and new borrowers. So thought, why not? Why not 3 days before Christmas? Let's run through this new program. So those of you that don't know, Adam Sweet, I'm a principal with Eide National Tax Office. I sit in Spokane, Washington, but really my role with the firm is I'm a resource for the whole firm. So I often tell people Spokane's kind of irrelevant to my role anyways. I'm born and raised in Spokane, so happy to be here, but there's no particular reason why I'm situated in Spokane for my job. But more pertinent really to our discussion today, I've been part of our SBA working group really since March. So been hosting webinars, insights, articles, and so forth, trying to be responsive to clients as they navigate through this program. And if you ever have a question about maybe a past webinar, I get the request from time to time about where's a link for a past webinar or maybe a past insight article we've done. I'd encourage you to go to idebility.com/PPP. I think we have all of our insights, past insights there, as well as our previous webinars and so forth. I always warn people, some of those could be out of date by this point because the rules have changed quite a bit. Like if you went back and listened to our webinar for March, I think you'd find the rules now are quite a bit different than as they existed in March, but still it's a good resource to head back to if you have questions. So today's agenda really is to outline this new legislation that is coming from DC, and kind of the pertinent parts are, one, we have some guidance on PPP qualified expenditures and whether they're tax deductible or not, and spoiler alert, they are now tax deductible. Also, there is a new round of PPP funding for both people who took the first round of funds and then also just new borrowers. So it in a way, think about it as a brand new program. And then also there are changes to the PPP loan forgiveness parameters. And this is for all borrowers. So not just for new borrowers, but people that borrowed back in the spring. We now have new rules for how those loans are forgiven. So this new legislation, it was passed by the House of Representatives yesterday, December 21st. Oops, my dates are wrong there. It should be December 21st, 2020, of course, not December 21st, 2021. I'll warn everyone that I was making edits to this slide deck as of about 30 minutes ago, just because we've had just a very compressed timeline. So you'll have to be forgiving if there's typos, and I'll probably see them, of course, as I go through this. And so I'll highlight those. So first typo, of course, it's yesterday was December 2020, not 2021. But House passed it midday, the Senate passed it at night, and our expectation is the president is going to sign this very soon, at which point it'll become law. So I read that I think there's over 5,000 pages in this latest piece of legislation, and because it both funded the government for the next year, then also created kind of material changes to existing programs. But apparently it beat the record for the Affordable Care Act for longest piece of legislation, or largest piece of legislation on record. So I don't know whether that's an ignominious record or it's something we should be proud of or not proud of, but I guess that's what it is. So if you read through the legislation, or more likely if you're reading articles in the Wall Street Journal or from your favorite Twitter follower, you're probably seeing lots of commentary about meals and entertainment expenses, which are now deductible, at least for a couple of years. Changes to the EIDL program, child tax credit, earned income tax credit, stimulus payments, everyone's favorite topic, where's my stimulus payment, extended unemployment coverage, tax extenders, and others. All of that is covered by this new legislation. But I think important for us is I'm not going to be covering really any of that today. We just don't have time. My focus is going to be on the changes to the PPP. So as part of that, we have $284 billion of new funds for the PPP, Paycheck Protection Program. If you're interested in these other topics, stimulus payments, tax extenders, and et cetera. Just stay tuned. We'll have insights that come out from our National Tax Office, from our DC office specifically, outlining some of these things. And I think as the weeks go on, we'll have more detailed insights on particular topics. So, and then again, disclaimer here, this is brand new. Really, we've had inklings of this new legislation, bits and pieces of it, but we had never really seen it until yesterday. So I'm going to be speaking to the best, with the disclaimer that it's to the best of my knowledge, the information I'm sharing today. And no doubt that there'll be further rules released that could change what I say today. I think back to even back in March when we were speaking about the CARES Act, and the night before we were going to give our first webinar, the SBA dropped its first interim final rule that changed a whole bunch of stuff. So no doubt that's going to happen here. So no doubt some of the things we say here will be modified in the coming weeks, or may even turn out to be not how the SBA interprets things. So the first topic today is PPP expenditures and whether they're tax deductible. The whole point of the PPP is to get money into borrowers' hands who would then use those funds to incur eligible expenses. So ineligible expenses are payroll, rent, utilities, and so forth. And really most of it is payroll, and that makes sense. It's called the Payroll Protection Program. So Congress gives you cash and says spend it on payroll. And then Congress says, we'll forgive your loan. And originally the CARES Act stated that when they forgive your loan, the income, there's no taxable event when that's forgiven. That, normally when a loan's forgiven, there's a taxable event, but as part of the CARES Act that was passed back in March, Congress said not taxable. And I think most of us interpreted that to mean there should be no tax consequence then to the whole PPP loan program. However, the IRS disagreed, and really, to be fair to the IRS, it was the Treasury Department specifically. I think that's pretty clear at this point that really it's the Treasury Secretary that was taking a firm stance on this. But what the government said was, sure, your loan, when it's forgiven, is not income, but your qualified expenditures that generate forgiveness are not deductible. Seemed a bit silly because de facto what that resulted in was the forgiven loan becoming taxable. No one really, I never quite understood, you could read, there are pages and pages of reasoning for why the IRS said it's not deductible, but it, just from a common sense standpoint, I never understood why it'd be not deductible, because it makes it taxable, and wait, Congress told us it's not taxable. And really several prominent politicians went on record stating that the IRS had it wrong. I think of Senator Grassley, I think Senator Wyden, and I think Senator Cornyn from Texas, that they said that the IRS just, flat, or really the Treasury Department just flat got it wrong. So good news here with the legislation that was passed yesterday and has not been signed into law, but hopefully will be signed into law today. That tells us that not only does gross income not include your forgiven amounts, which we knew, but it also says that your qualified expenditures generate deductions, so that indeed your forgiven loan is not taxable. And Congress, the way they structured the language is that they call this a clarification, meaning that this was congressional intent from the get-go, meaning it's effective as of the CARES Act. Even though this is legislation that was passed here in late December, it's going to be retroactively effective to the beginning of the CARES Act, to the beginning of the PPP program. So that means all your eligible expenditures are now tax deductible. It's interesting, even over the weekend, we were hearing rumors that they may not make it fully deductible for everyone. There was discussion of quote unquote guardrails being put into place, meaning that it could be deductible for some borrowers, but perhaps borrowers who had gross revenue over a certain amount, or borrowers who had not experienced a decrease to gross revenue over a certain amount would not be able to claim the deduction. I think from a practitioner standpoint, we're very happy they didn't create those guardrails. It would have been horribly complex. If you can think of trying to do year-end planning and trying to, in the determination of whether something's deductible is whether your gross revenue declined by a certain percentage point, that would have been it would have been a tough calculation to make. So in a way, I'm glad either they say it's not deductible 100% or make it deductible 100% just for clarity's sake. And I'm obviously happy for our clients that they reached the right result from my perspective in making it fully deductible. So again, this previous slide was from a summary of the bill provided by Congress, but this next few slides are actually directly from the statute. And what they call it is clarification of tax treatment of forgiveness of covered loans. And they say forgiven loans are not taxable and eligible expenditures are fully deductible. Special rules for partnerships and S corporations. And if you think here, why do we need a special rule? Well, when you're a partner in a partnership or a S corporation shareholder in an S corporation, you receive an allocable share of, let's say, losses or deductions. You need tax basis in your partnership interest or tax basis in your S corporation stock in order to claim those deductions. So just making the PPP expenditure deductible doesn't necessarily solve the problem. Congress, in its infinite wisdom, said, hey, we see this issue. And so what they said was that the forgiven loan proceeds are treated as tax-exempt income, and that it increases the S corporation shareholders' basis and it increases the partners' basis in their partnership interest, allowing for both of those, both the shareholder and the partner, to claim their deduction. So that's good news there. One issue we just are thinking about now, and I don't necessarily have a ton of clarity at this point to it, but if you're an S corporation specifically, and your loan is not forgiven by year end, well, technically you don't have tax exempt income. And therefore, there's no basis for the S corporation shareholders, no basis increase for the S corporation shareholders. And does that mean then that if your qualified expenditure deduction could be disallowed for 2020? It'd be suspended, not disallowed, it'd be suspended potentially till next year. Also, same issue for S corporations that distribute substantially all of their cash, where I think quite a few S corporations, especially that are, have a lot of service type income, they may have covenants that say they have to distribute X percentage of their cash after paying debt and reserves and so forth. But again, that could create basis issues because you have a pile of cash inside the S corporation, you have some deductions to allocate out, and yet the shareholders do not have basis yet because there's no tax exempt income till the next year. So we'll see how this will play out. You don't have the same issue for partnerships because in the partnership setting, the PPP loan gives partners debt basis, both recourse, non-recourse debt on a partnership's books gives basis for partners. Not the same rule for S corporations. Generally speaking, S corporation debt doesn't give S corporation shareholders basis unless it's a shareholder loan. So a particular issue for S corporations, we're thinking through it. I was just talking this morning to several of my fellow partners on this issue, and we don't really have an answer. There may be some planning to do, or maybe some creative arguments to make, but we'll see. Maybe the IRS as well will give us some guidance. So this really solves then, going back to making it deductible, there's all kinds of ancillary issues. If expenditures were not deductible, there were issues for purposes of the 199A QBI deduction, for the R&D tax credit, other code provisions that keyed in on having deductible eligible payroll. For the most part, that was the issue. If it's not deductible, suddenly maybe you couldn't use it for 199A for R&D and so forth. But now that issue's off the table because it's deductible. So it should close the loop on that. And then finally, again, it's retroactive, so it applies to all PPP loans. So it's not somehow, it's not just for new PPP loans, it's for loans that were incurred back in March, April, May, June, all the way till now. So moving past the deduction discussion, so the other big point to make with this new legislation is that there's now what's called, I call it a second round of PPP loans. Congress calls it Paycheck Protection Program second draw loans. So a couple of things here, and we'll get through it here, but big picture, second draw loans are available for both new borrowers as well as existing borrowers if you meet the eligibility requirements, which we're going to dive into here in a second. So if you got a loan back in March, you could be eligible for a second loan. You need to be an eligible entity. This is kind of a new defined term. We'll dive into that in a second. And then also just the list of qualified borrowers has been expanded. We won't get into too much detail on this, but there's some different types of organizations that weren't previously qualified that are now qualified. So first, if we know you need to be an eligible entity to take a second draw PPP loan or second round PPP loan, what is an eligible entity? Well, it means any business concern, nonprofit, housing cooperative, veterans organization, tribal business concern, self-employed individual, sole proprietor, independent contractor, small agricultural cooperative. So really, the whole universe of businesses are really gathered here. A couple of notable exceptions would be farms, Schedule E, if you're a landlord, let's say, does that qualify as a business concern? Not too sure. So maybe there are a couple of things there that you're not sure if you're covered by, but generally any operating business you think is going to be covered by that first part. But not only do you need to meet that definition there, the key point is you need to employ not more than 300 employees. You think back to the CARES Act was 500 employees. So they've ratcheted this down to 300 employees. And then secondly, you have to demonstrate at least a 25% reduction in your gross receipts in the first, second, third quarter of 2020 as compared to the same 2019 quarter. Now there are special rules. If you weren't in operation in 19, there's special rules. And then also, if you submit your application for a second round of funding after January 1st, 2020, or after January 1st, 2021, you can use fourth quarter receipts, 2020 fourth quarter receipts. So again, big differences from the first CARES Act. One, first edition of the CARES Act or first edition of the PPP was 500 employees. Secondly, you didn't have to demonstrate a reduction to gross receipts on the first go round. Now you need to demonstrate at least a 25% reduction in gross receipts during one of those first 3 quarters of 20 as compared to the same quarter of 19. So now you may be asking yourself, well, what does gross receipts mean exactly? Is that a tax concept? Is that a financial statement concept? The answer is we don't know. It would be strange for it to be a tax concept because you're not going to have your tax return ready necessarily until sometime next year. So when you're trying to break apart what your gross receipts are for tax purposes, you just may not have that information. But same issue for financial statements, that it may be, what is it, February, March? Typically bank covenants are requiring that financial statements be completed. So I don't know exactly what the SBA is going to look to you're going to have to, a borrower is going to have to show a reduction in gross receipts, but how they're going to do that, I don't know necessarily. I don't know whether you'd be using bank account information. I don't know whether there'll just be some type of self-certification. Just don't know. And then also, if you're not in business as of February 15th, 2020, you are not eligible for this second round. So yeah, there's special rules for if you're not in business during 2019, but you need to be in business as of February 15th, 2020 to be eligible for this second round. So the other modification here is, if you think back to the first round of PPP, when you applied, your loan could be the lesser of 2.5 months of payroll or $10 million. So for this new round, they've kept again the 2.5 months of payroll. So you'd look back to 2.5 months of payroll, but the loan can't exceed $2 million. So it was 10 million before, now 2 million. So again, they're ratcheting it down. I think their focus was, for the most part, trying to get this new program focused on quote unquote smaller borrowers. And again, if you're trying to figure out what is 2.5 months of payroll, well, Congress in the new statute said you can either use a 1-year rolling period, looking back 1 year before your application date, or you can use the 2019 calendar year. So I suppose you'd be using whatever period is most beneficial to you. And then there are special rules, as always, for seasonal employers, for new entities and so forth, that provide special rules for how to calculate that. We're not going to get into that today. But if you're a seasonal employer, or if you're new, as long as you existed as of February 15th, 2020, the special rules for you, reach out to your Eide professional or whoever else you consulted with for PPP to go into those rules. So 300 employees. So before it was 500 employees, now it's 300 employees. And you must meet the gross receipts test, the reduction in gross receipts test, but we still have the same exceptions that applied before. So, taking a macro view here of the way the SBA programs generally work is they have these different size requirements, including number of employees. There's rules of affiliation, though, that can cause multiple businesses to be tested together. So I could have two different businesses I own, each with 300 employees. But if I have enough common ownership and common control, they are grouped together for SBA testing purposes. Suddenly I have 600 employees, and I wasn't eligible for the original PPP loan because I have more than 500 employees and certainly wouldn't be eligible for this new round. But there are particular exceptions to these affiliation rules that were part of the original statute, and again, are part of this second round of PPP loans. So the first exception is business concerns with more than one physical location. You test 300 employees per location, as long as they have the NICS code 72 associated with their business. So that's going to be restaurants and businesses involved in the hospitality sector. I have a second slide here in a second going into more detail there. Also, there is a waiver of the affiliation rules. So multiple businesses under common control are not treated as affiliated, and they're not tested together for 300 employees. If one, they have the NICS code 72 associated with the business, or two, if they're operating as a franchise and they are assigned a franchise identifier code from the SBA. So these are the same exceptions we had back in the spring. So if you're able to rely on one of these exceptions, we think that now you can continue to rely upon that exception. The only difference being you would have to show now that you have 300 employees and that you meet the gross receipts test. So maybe said another way, if you have 300 employees or less right now and you meet this reduction in gross receipts test, and you met one of these exceptions in the spring, well, then you'd be eligible again now for a second round of PPP loans. So what is, well, first of all, there's a special rule particular to NIACS 72 entities. Your NICS is your industry classification codes. If you have that NICS 72 classification number associated with your business, so you're in the hospitality sector, you're a restaurant, you can use 3.5 months of payroll when computing your maximum loan. Now, you're still subject to the overall $2 million cap, so it can't exceed $2 million. But if 3.5 months of payroll gets you more, it's $2 million or less, but it gets you more than the 2.5 months, well, then you can use this rule. Effectively, this is just an extra month's worth of payroll that these NICS 72 entities can use for incurring a loan. We had this question come up quite a bit, really even over the summer, and it came up again recently. And I know that it's going to come up again now because we have these special rules for NICS 72 entities. What is that code? Well, if you Google it, you will see that the NICS code 72 is the accommodation and food services. And they tell you that generally it's businesses if you're providing lodging to customers or preparing meals, snacks, and beverages for consumption. Who's excluded? Well, your social clubs, your country clubs and so forth, amusement parks, theaters and so forth. The question that we get often is, well, what if I have a business and maybe part of what I do is offer, let's say, hospitality, food or drinks, but maybe the other half of what I do is something else. Kind of how does that work? And I'd encourage you, if that's you, if you go to the NAICS website and you click on the 72 classification link, there's going to be a whole subset of businesses that expand. And I've taken a screenshot here, and they have explanations for a whole bunch of these. So, for instance, the one I've seen is casino hotels. There's a rule for hotels that offer lodging and food, but maybe also have casinos inside, that they can be classified under the 72 code. So just do some homework there and expanding that out, that if you think maybe you don't fall under the 72 classification, or if you're just not sure, you may be able to do a bit of homework there and say, well, maybe I fit under one of these subcategories. So how does it work if you're planning, if you say, hey, I've had the gross receipts reduction, I have under 300 employees, I'm eligible for a second loan, for planning purposes, how are the rules going to work? Well, generally, they're going to work the same way they did before, that you're going to get your loan, and to get full forgiveness, you're going to need to spend the loan proceeds on the qualified expenditures. Included with that is 60% of what you spend needs to go to payroll. You're going to have to pay attention to your full-time equivalency counts, your salary reduction tests, et cetera. If you're cutting your full-time equivalence count, if you're reducing employee salaries, these would be employees that make under 100 grand, that could reduce your forgiveness. So it's the same rules we've had before. So that's nice that they didn't give us a brand new, somehow brand new test that could reduce your forgiveness. So I think it'll be helpful for the SBA when they need to promulgate new guidance here, that they can, some of the guidance they already have out, they can continue to rely upon. One thing, this came up, I noticed it yesterday and I saw it in a few articles today. The new legislation does not have a safe harbor date for restoring FTE salary reduction. The CARES Act originally said if you've cut your FTEs or salaries and you reinstate those cuts by June 30th, and then that was extended by Congress to December 31st, that you wouldn't have a forgiveness reduction. We don't have that, as far as I can see in the legislative text, we don't have that same safe harbor date. Now, there is some legislative language that says the SBA has the authority to kind of fill in the gaps, let's say, not specifically to here, but in other areas. So perhaps the SBA will, take that as giving it the authority to fix this. It would sure be helpful to have that date out there that you could restore. We've had quite a few clients that have been able to rely upon that safe harbor and say, yeah, I cut FTEs, I cut salary reductions, but I'm going to restore them by X date, and therefore I don't have a forgiveness reduction. So hopefully we'll get that same guidance from the SBA. So then I know the question that probably is burning in the minds of most of the people attending here if you received a first round of PPP loans, can you take a second round? And I think I gave away the answer earlier. The answer is yes. And the statute explicitly tells us the answer is yes. And it just says eligible entities that took a first round of PPP loans can borrow again, so can take a second draw if they meet all the eligibility criteria for the second round. So that's your 300 employees, your 25% reduction to gross revenue, et cetera. And if the borrower on or before the expected date on which the covered loan, which would be the new loan, second loan, under this paragraph is dispersed, has used or will use the full amount of the loan received. And then finally, I'm not sure how this will come up, but the statute does say that an eligible entity can only receive one PPP second draw loan. I don't even know under the first statute whether eligible entities were able to take multiple PPP loans. So I noticed that in the statute, put it here. I don't know how relevant that is, but just know if you get your loan, you won't be able to get a second loan. If your loan, so if you're 2.5 months of payroll or your 3.5 months of payroll, if you're a restaurant or in the hospitality industry, if your loan's going to be up to $150,000 or less, the statute tells us that there's going to be simplified application procedures for those types of loans. And I think all you're going to need to do is make certifications about your gross receipts. So you may not have to provide financial records. And that begs the question, well, if you're going to borrow more than 150 grand, it sure seems like you're going to have to provide records of some sort. And like I stated, 10, 15 minutes ago, we don't quite know how you're going to demonstrate that. But good news, if your loan's 150 grand or under, you're going to have some type of simplified procedure, yet to be seen procedure for how to get your loan. And again, all other loans, if they're above 150 grand, you're subject to the existing rules. And I think it includes the need to certify that you need the loan due to the economic uncertainty caused by COVID. You know, if your gross receipts have been reduced by more than 25% during one of those 2019 quarters, it seems like that won't be difficult for you to meet. But that's the same language that was there originally, and it's still there now. So I would expect the forgiveness forms, or sorry, I would expect the application forms when they're released, the new round of application forms will continue to have that language. And then finally, there's, just to emphasize this point, I hit upon it in our webinar in November, but the Congress is making it even clearer that lenders are really held harmless under this new statute and really under the old statute, meaning that if there are errors in an application for a loan or errors in a forgiveness application, it really isn't the role of the lender to catch those, one. And then two, the lender isn't liable for those. You know, if they occur, the lender's not liable. And it's really the risk is onto the borrower. So we talked about it back in November. Just I want to hit that point again, that, you know, we've heard from more than a few clients and we've discovered issues maybe with their original application, or maybe there's issues with their forgiveness application. What clients will say was, well, you know, I was using my banker and I gave all the information to the banker and I just trusted the bank knew what they were doing. And the answer is, one, maybe the bank didn't know what they were doing. But secondly, it's kind of irrelevant because the bank isn't liable regardless. It's the risk is back with the borrower. So if there's some issue ultimately with your loan where the SBA doesn't like something, your lender's not going to be able to protect you. I don't know, this is another kind of curious provision that I saw last night. I originally wasn't going to include it as part of this presentation, but I read a couple articles this morning that raised the issue. So I thought I'd put it out here just in case it becomes relevant. But what it says is borrowers who returned all or part of their original PPP loan can reapply for the maximum amount applicable, so long as they have not received forgiveness. So you can almost kind of right size your loan. And you can also do this if you originally calculated your loan and it turns out subsequent guidance tells you that your loan could have been a lot more than what, or could have been more than what you had. Again, you can right size your loan. You know, this came up with, originally we weren't too sure how payroll was defined when we first had it in the statute, and maybe you excluded some things from payroll. And it turns out the SBA gave a, you know, with an interim final rule, said was more expansive with the definition of payroll than what you included in your application. So potentially here, this is saying you can right size your loan. I don't know how this is going to work. Congress, and I'm sure the SBA appreciates this over the Christmas break, Congress says the SBA has 17 days to release guidance on this particular topic. So I'll be interested to see what happens here. I don't know of very many clients that returned any portion of their PPP loan, but I can imagine there's going to be borrowers out there and our clients out there that maybe could have borrowed more than they did. And maybe they asked about it over the summer, and our answer was, well, we don't see any way that you can right size your loan at this point. But it appears now we have a way to do that. So let's kind of all stay tuned to what this guidance will say coming from the SBA. And once we know more, then I'll try to write an article or have another webinar on this particular topic. A couple other interesting new entities that are eligible for a second round of PPP loans. One, there's an interesting exception here for newspapers and other people involved in the news industry. They're first exempt from kind of the affiliation common control rules. And then secondly, they have their own special employee limit per physical location, 500. So that's interesting. I don't know if I know of any clients that would fit this profile, but there's no doubt people out there that local news organizations, local newspapers that could sure use a PPP loan that have been hit pretty hard with COVID. So I think this will be very attractive to those borrowers. And then secondly, certain 501c6 organizations are now eligible, with the exception being if they're involved with more than a bit of lobbying, then they're not eligible. And then finally, there's special PPP grants for shuttered venue operators. Think independent movie theaters. Like I think in Spokane, for instance, we have a couple of, our symphony is in a local restored theater. I know many cities have something similar. So I think those types of businesses are going to be eligible for the second round of loans. It's good because they've been hammered particularly hard. They've been, I think of our local theater here, and our local theater that houses our symphony in Spokane has been shut down now for 8 months. It's probably going to be shut down for another couple of months. So they've gone a full year now without revenue. So certainly deserving of this funding. Okay, so we've covered the deduction issue. We've covered the second draw, and I like that word, the second draw PPP loans. So kind of the third prong of this, let's say, is we have updated forgiveness rules. And these are updated rules for both new borrowers and existing borrowers. So the statutory language is retroactively effective back to the enactment of the CARES Act, which is early March 2020. So all PPP borrowers can use these new rules if eligible. There were rumors for the last few months that Congress was going to simplify the forgiveness process for all loans under $2 million, and that they were going to make it particularly simple for loans under 150 grand. Turns out what we ultimately got was just one special rule for loans up to 150 grand. So no special rule for loans above 150 grand, but for loans up to 150 grand, there are new forgiveness parameters. And all you're going to need to do, if this is you, is sign a certification that Congress has told the SBA will not be any more than 1 page in length. Now, they didn't tell the SBA what size font they can use. So this is always tricky in the SBA, that sure they can make it 1 page. It's like when they made the tax return, was it the 2019, the postcard tax return? So always be a little careful here when Congress, tells an administrative agency to do something in 1 page or less, or do something on a postcard. You're never quite sure what you may get. But some form or another, a signed certification that the eligible recipient only has to provide a description of the number of employees they're able to retain because of the loan, the estimated amount of loan spent on payroll costs, and then the total loan value. And you need to include an attestation that the eligible recipient has accurately provided the required certification and complied with the requirements and has retained records to prove compliance. So that's it. So you're not going to have to submit documentation. You're not going to have to be doing, I assume you're not going to be doing the FTE, the complex FTE calculations or salary reduction computations and so forth. So we don't have this form. I mean, we have what Congress told the SBA to do. So let's see what this new form is going to look like here in the next couple of weeks. Bad news, really, and I cover this in a second, but bad news is if you're above 150 grand, you're just stuck with what we have. So no new guidance particular to you if you're above 150 grand. I think you're probably stuck with the current forgiveness application. You're stuck with the with the current documentation requirements and so forth. And I wouldn't expect the SBA to simplify the process any more than it's already done so for those types of loans. We have an update on what counts as an eligible expenditure. So remember, again, you get your loan, you use your loan and eligible expenditures in the right ratio, and then you get forgiveness. And the new loan, the new second draw loans include the original category of eligible expenditures, which is payroll, covered rent, mortgage, utilities. And again, you need 60% as payroll. But we also have new categories of expenditures that count as qualified expenditures. And I just warn you here, I've used the summaries that were provided by Congress, and they're kind of summaries of the bills. I did not copy and paste the actual language from the statute because it was just too long. So if any of these are of interest to you and you need more certainty, I would really encourage you to go to the actual statute or wait for the SBA when they provide further guidance. That this is not, I'm not intending this to be an all-inclusive definition here. So these new categories are, what are they? Covered operational expenditures, covered property damage costs, covered supplier costs, covered worker protection expenditures, and I dive into more detail here for each of these. But each of those can go into that 40% bucket. The 60% bucket still needs to be payroll, but we now have an expanded list of expense categories that go into that 40% bucket. They also told us, they being Congress, also told us that the definition of payroll costs now also includes employer-provided group insurance benefits like group life, disability, vision, or dental insurance. It's interesting, I probably would have told you if you'd asked me that this was already included in the definition of payroll, but there must have been some ambiguity out there, so the causing Congress to clarify these things. So if you're thinking back and you say, wow, if I could have used these new categories, I could have achieved more forgiveness. Well, the new legislation says that any borrower can use these new categories, so even existing borrowers, so long as you have not yet received forgiveness of your loan. But practically, we think the way this works is you can really only use these new categories if you have not yet submitted your forgiveness application. Because your forgiveness application, to our knowledge, at least now, there's no way to amend the application. Now, maybe this will change. Maybe the SBA will come out with a rule in the next 2 weeks that says borrowers who have not achieved forgiveness, full forgiveness, can amend their forgiveness application to account for these changes. We don't have that yet. So as of right now, I think really, yes, an existing borrower can use these new categories, but really only if they have not yet filed their forgiveness application. If they had, I don't think you can pull that forgiveness application back yet to use these new categories. And again, it would make sense for the SBA to provide relief for this in the coming weeks, and we may have that, but as of yet, we don't have it. Covered period, covered period's all about you don't have an infinite amount of time to incur eligible expenditures to generate forgiveness. The CARES Act originally had an 8-week covered period. That was then expanded to 24 weeks. But still, you had to choose an 8-week or a 24-week covered period, although the SBA said you could apply for forgiveness early. The new rule lets you choose a covered period between the 8 and 24-week period. So you start counting on your loan origination date. You could choose an 8-week covered period. You could choose a 9-week covered period, a 10-week covered period, all the way up to 24 weeks. And you might say, well, isn't that practically what the old rule said, because you could apply for forgiveness? And the answer is no, because the old rule said, yes, you could apply for forgiveness early, but let's just say you applied in week 12. Technically, you'd still have a 24-week covered period. And this created uncertainty because we don't quite know is, well, did you have to somehow maintain your FTE count? If you apply in week 12, do you have to maintain your FTE count until the end of the 24-week covered period? Seems to be the answer now is no, because you could choose, if you apply in week 10, that's the end of your covered period. And that would be your testing date for FTE and salary reductions. So this is a beneficial rule. And then also the old language from the CARES Act as modified by Congress said that the PPP program ended on 12/31/2020. That is gone. Obviously, it needs to be gone if we have the second round of PPP loans. So people's covered period can now extend beyond 12/31/2020. So if you just received the loan in the last month or two, you can extend your covered period into 2021. And again, my comment there about relevant tests measured as of data application, relevant tests would be your FTE count and your salary reduction count. One other interesting question here to think about is, there was a debate, if you think back to, if you filled out your forgiveness application, there's limits on total compensation you can include. For owner employees, I think it's $20,300. For non-owner employees, it's $46,000 and change is the maximum eligible compensation. And if you use the 24-week covered period, and there's some debate, but I think a decent argument could be made that even if you applied in week 12, you could still use the full $46,000 and change number for non-owner employees, or the $20,300 number for owner employees, even if you were, again, even if you were applying in week 10. Because the SBA said, well, even if you applied in week 10, you still have the 24-week covered period. the question now is, does that change? Because now if you apply in week 10, you actually have a 10-week covered period. So does that mean that the maximum compensation you can pay to a non-owner employee is 10 divided by 52 times 100 grand? I don't know. It's conceivable, and it was even, I think, an open question. Even our argument we were making, it wasn't 100% clear. That was our best reading of the rules. So maybe we'll get additional guidance from the SBA that clarifies that point. Couple other programs that are affected, and I am not an expert in either of these programs, so I think we do have groups at Eide Bailey that do have specialization in both of these programs, and I encourage you to reach out to them with questions. But the CARES Act had several incentives for employers to retain employees during the COVID crisis. One was obviously the PPP, but the second was the employee retention credit. And the employee retention credit was generally available to anyone. There wasn't a size restriction necessarily. So if you were too big, if you had a couple of thousand employees, so you were too big for the PPP, you could be eligible for the ERC. Originally, the ERC was valuable, not nearly as valuable as the PPP would have been if you worked it out on a dollar for dollar basis, because the ERC gave you a credit for your payroll, but it wasn't free money like the PPP was. But the legislation that was just passed increases the possible credit from a max of 5 grand to 14 grand per employee. 1. 2, it also tells us that PPP borrowers can make use of the employee retention credit. The CARES Act said they were mutually exclusive. If you took a PPP loan, you could not take could not claim the employee retention credit, and vice versa. So now you can, it's just you can't double dip on the wages. So the ERC keys off of eligible wages. Eligible wages for ERC do not include wages you covered with PPP loans, but many borrowers are going to have other wages that weren't covered by PPP loans that now could generate an employee retention credit. So really good news for borrowers. And then 2, I think we're going to see the employee retention credit become a much bigger deal because it's a much more valuable credit now than it was before. And I'm sure there's tons of questions. Jim Donovan and Joe Stoddard are 2 partners as part of our national tax office that normally are in the R&D tax credit space, but they're leading up our employee retention credit working group. So I encourage you to reach out to them if you have specific questions. And then secondly, the EIDE loan, and I always get the acronym wrong, Emergency Insurance Disaster Loan, I think is what the EIDE stands for. This was another program that was included in the CARES Act. Actually, it's a program that's existed for a long time, but it was modified in the CARES Act. And one of the modifications says that you could get an EIDE grant of up to $10,000 that you didn't have to pay back. But the CARES Act said that would reduce dollar for dollar any forgiveness. The new legislation from Congress says now, no, PPP borrowers do not reduce their forgiveness amount by the amount of any EIDE advances. So good news. And here's kind of the more technical statutory language, or not language from the summary of the bill below. So I think this is grandfathered in as well. So there's some provision there for the SBA to make borrowers whole if you've already achieved forgiveness, or if you've applied for forgiveness and reduced your tentative forgiveness amount by the amount of any EIDE grants. I think this gets right-sized for you. And I don't know how the SBA is going to be tracking this, but just keep that in the back of your mind that I think you're going to be made whole by this, because you can now get the grant without it affecting your PPP forgiveness. So, next steps, obviously are the current round of applications, guidance and forgiveness forms, et cetera, will all need to be updated for a variety of reasons. I mean, one, we're going to need new application forms for people applying for the second round. We're going to need new guidance on the second round. How do you measure gross revenue? Guidance for the $150,000 or under loan. On the forgiveness side, we're going to need the new simplified forgiveness form for people that have loans of 150 grand or less. I'm sure we're going to have new guidance on these new categories of eligible expenditures. I'm sure we're going to get further guidance from the SBA that fleshes that out. So, fun times for those of us that were hoping we could move on from the PPP. There'll be no moving on, at least for the next, 5, 6, 7, 8 months. And really, we can look forward to a whole bunch of new guidance coming from the SBA very soon. And why? Well, what Congress said was not later than 10 days after the date of enactment of this act, which is what was, it's not yet signed into law by the president. So the 10 days would start when the president signs it, but I think that could happen today. The administrator, who's the SBA, shall issue regulations to carry out this act and the amendments made by this act. Now, I don't know practically how this is possible, especially, given that we have Christmas and New Year's coming up. I don't know how the SBA is going to be able to do this, but, Congress said they have to do it. So I guess they will figure out some way of doing it. And even if it's not exactly 10 days, I think we're going to expect this guidance pretty soon. You think back to the CARES Act, we still have interim final rules that are coming out now, 7, 8, 9 months after the CARES Act, that are interpreting the CARES Act and specific to the PPP. I think we're going to have a much more rushed timeline here. Now, one, a lot of the guidance that's already out there is still applicable to the second round, but and two, the SBA has now more experience with the program, so it may be easier for them to issue this additional guidance. But still, they're up against it. The worry would be if they are rushed to issue this guidance, are there going to be mistakes made? Is there going to be a form that comes out that has kind of a material mistake and somehow has to be edited? We'll see. Another thing I'm watching in particular is the new loan applications. If you remember the original loan application, all you really had to attest is that you needed a loan due to the economic uncertainty caused by COVID, and that you would use the loan to maintain payroll. And now we have this form 3509 that's floating out there for borrowers with loans in excess of $2 million. And there's this whole series of detailed questions these borrowers need to answer before they can get forgiveness. And so I think the question is, will some of those questions on the 3509, will they suddenly show up on these new application forms? Because one of the big pieces of criticism of this 3509 is that it's retroactive rulemaking, that none of these questions existed as of the date of application. And now it's somehow kind of a form of we got you from the SBA, that they're creating rules now that retroactively apply to the beginning that call into question someone's eligibility for the loan. So if the SBA are going to continue to stick to their guns on this 3509 and asking borrowers to answer these questions, I might expect some of these questions to make their way onto any new loan application form. And then, the pool of eligible borrowers. This started, legislation a couple of months ago started with saying that you needed to show a 50% revenue decline. And given that they ratcheted that back to 25% revenue decline, and given that you can be strategic about what quarter in 20 you use to demonstrate that, I would guess there's going to be more borrowers than first anticipated that are eligible for this, because I think you could even have businesses that ended up having a decent 2020, but really decent because they pulled through during the summer, late summer, fall, the third and fourth quarters of 20. They may be able to go back and use first or second quarter revenue figures, back February, March, April, May timeframe when things were shut down. And they're going to be able to show, if 19 was a really good year, they're going to be able to show a quarter on quarter revenue decline and maybe be eligible for the PPP loan. So, and a lot of this is going to tie back to how do we measure gross revenue? We don't quite know yet. We'll need guidance there. But there may be more. The more I thought about this yesterday and this morning, I think there may be more than a few people that first look at this and say, oh, I'm not eligible because I had a really good year. Maybe if you strategically look back at which quarter to choose, you may be eligible for it. And then again, back to my question there in 3509, some people maybe hoped that Congress would have put some comment in the legislative text or in the bill summaries stating that the SBA had kind of overstepped on the form 3509. There's really nothing in the legislative text, unfortunately, that talks about those questions on the 3509. There is a lawsuit currently filed by the AGC, which is the Associated General Contractors of America. They filed a suit against the SBA on December 8th over this Form 3509, basically challenging the 3509, is stating the SBA really exceeded their statutory authority. It'll be interesting to track. I think if you're interested, pull up the lawsuit. It makes a lot of really good points, salient and really logical points. I think the only unfortunate thing is, the outcome and timing of a lawsuit's always uncertain. And will it be resolved? By the time it's resolved, will have everyone already submitted their loan application? And given that you get this, if you have a loan in excess of 2 million, you get the 3509, you have 10 days to reply, to send the 3509 back to the SBA. How helpful is this lawsuit going to be? I don't know, but an interesting thing to watch. And who knows, maybe if they get injunctive relief quickly, maybe there will be some impact to borrowers. Excellent. Well, that is it. That is it for us. So I'll give you a minute back to your day. I just want to state just one quick point here, that this legislation just was released yesterday. So there's no doubt lots and lots of details that we don't yet know about. There are going to be new forms, new everything that will come out. And you can't hold me to it if I'm wrong on something today. Not my fault. When you have 5,000 pages of text to try to read through and try to digest, and can't hold me responsible necessarily. And I say that with a smile on my face. So I may be back to you in a month from now saying, oh, remember what I said a month ago? It's not quite correct. So with that, I hope everyone has a Merry Christmas and a Happy New Year. And if we don't talk to everyone sooner, we'll talk to people after the new year. Thank you very much.
Thank you, Adam. Everyone have a great Christmas and holiday season.
Thanks, Amy.